Excluding shelter, CPI headline is at 2.0%.
But shelter is so important.
But it lags.
Right.
It lags like crazy.
If you use a different measure of shelter inflation, there's literally no inflation.
Inflation is likely to come down, which is likely to take the 2-year down as the Fed can take its foot off the brake a little bit here. The 2-year can come down as the 10-year comes up, and it doesn't have to be catastrophic.
The bond market's saying, kiss my ass with that shelter thing. The bond market is saying this is not over yet.
You don't need to hike anymore. You got tightening on that long end. It looks like another third quarter boom in productivity. This is the best news. I mean, that's how you can have strong GDP growth without pressure on the labor market and really without pressure on inflation. That's the golden magic over here. That's really playing into why yields are going up. Also, real GDP growth and real yields. You know, I'd like to comment. You guys had a great discussion right at 6 o'clock when you opened about real returns and the tips going to 2%. Is that a way that you should now invest in for wealth? Let me mention 2% a year. It's good. It's the biggest in decades. However, 2% after inflation a year takes 36 years to double your money. At a 20 PE, which you also mentioned, which is right, that's a 5% earnings yield in stocks, the general S&P 500. That takes 14 years to double your money. Bonds are as good as stocks. No way for long-run wealth creation. I'm talking about building longer-term wealth. You don't need to hike anymore. You got tightening on that long end. Listen, the term structure is uninverting. Do you want to invert it more? Yes, you will if you raise another 25 basis points on the 10-year.
The benchmark 10-year U.S. Treasury note is currently at 4.34%. The reason why it's important is because it's the cycle high. In fact, not just a cycle high for this time around, it goes to the highest level that we've seen going all the way back to 2007, before the great financial crisis. Many mortgages are benchmarked off the 10-year U.S. Treasury note. It represents a real paradigm shift, a sea change in the way that we've been dealing with rates over the past 10 to 15 years in terms of the low level of them.
Okay, so it does. I think what it impacts most is the competition for equities. That's really the biggest challenge about yield spiking. Now, let's understand, it's the 2-year going back to 5%. It's the 10-year returning to levels that we haven't witnessed since 2007. It's the 30-year going back to 2009 levels. And it's inflation-protected securities above 2% for the first time since 2009. And it's just, okay, the risk-free rate versus the rate of return on equities, do I want to assume the risk or not? And that's the conversation right now. I don't think it's in any regard about where we were in 07 and 08 regarding residential real estate. Let's remember something, that there was a very well telegraphed message from the Federal Reserve about the impending rise in rates. So corporations got well ahead of what their debt maturity needs might be and extended those maturities. Fortunately, corporations, S&P 500 companies, you're talking about over 70% of debt maturing 5 years from today. Consumers, home buyers, okay, they're maintaining their, sub 4% 30-year mortgage. They're not going to forfeit that. They're not going to trade that out for an 8% mortgage. So I don't think it's the pressure that's being exerted on consumers and corporations in the debt markets. I just think it's the competition for equities. It's an uncomfortable place for us to be in, and it really falls on Chairman Powell on this Friday to ensure that he strikes a balance. Because if Chairman Powell doesn't strike a balance, if he has the type of tone where he did last year in that 8-minute remark that sent the S&P down 3% over the next week, it's going to be the bond market that's going to go parabolic. And that's going to be a problem for the capital markets.
This is very much about the competitive dynamic for your money. With yields, the way that they're trading right now, in that kind of 4 to 5% range for anything from savings accounts to money market funds, really makes it attractive to just hold your money there and not deal with any risk whatsoever, because it's all guaranteed by the full faith and credit of the U.S. taxpayer.
The dynamic of how attractive these yields are will change when equities get a rally. I think we've got to put August in its place. This is seasonality that's happening here. When you get a pullback like this, there's always a reason. There's always a reason. It's rates, it's China, and there's always a legitimate reason. But what we have to understand underneath this is we've got a darn strong economy. We've got a really strong economy. Now, I'm not saying I believe the 5.8% figure from the Atlanta Fed GDP now. It's probably lower than that, but that's a pretty big number on the face of it. And you got jobless claims in the low 200,000s. You got retail sales picking up. We have got a strong economy. There's a basic reason why the 10-year is going up in yield. It's because of economic strength. And this yield curve, which has been inverted and vexing people for so long, is uninverting by the long end of the curve coming up. Now, what's interesting and what I think we should all be looking for is what happens on the short end of the curve, what happens at the 2-year. This is going to depend critically not only on what Chairman Powell says on Friday, but what happens with inflation. Excluding shelter, CPI headline is at 2.0%.
But shelter is so important. We all need roofs over our heads.
But it lags. Right. It lags like crazy. Inflation is likely to come down, which is likely to take the 2-year down as the Fed can take its foot off the, off the brake a little bit here. I'm not calling for an imminent rate cut, but the 2-year can come down as the 10-year comes up, and it doesn't have to be catastrophic. The one canary we got to look out for, though, is the regional bank index. It's what you got to look for. It happened in March. Interest rates are now higher. You got to keep an eye there.
7.8% shelter inflation is the official numbers, which is what's biasing the official numbers higher. If you use a different measure of shelter inflation, using something like the K Schiller real-time data, Zillow rent data, so you can get much more real-time than the way the BLS surveys it. Right. Our number is like less than 1%. If you just plugging in a more real-time shelter to CPI, there's literally no inflation.
You think we could be in negative inflation?
According to the San Francisco Fed is highlighting where shelter can go middle next year.
Tell us what we're looking at here.
So these are my calculations on the left of what is headline inflation, which is the top chart. The official numbers were like low 3s. My number was 0.5% is headline inflation if you substitute real-time housing. Core inflation, instead of 4.7, which is the official BLS numbers you see, my number is 1.5.
Barring an oil price spike, at this point, virtually all of the inflation is shelter, and more recent shelter numbers away from the BLS are telling us that there's no inflation.
So the San Francisco Fed published something with a lot of similar numbers. They use the K Schiller, they use the Zillow, they use all these different real-time housing, and they show that the official shelter inflation is likely to get negative.
But the market is pricing in that they're done.
They might not be done. Let's just wait 5-6 months so it stays, and then we'll even talk about.
They're going to keep going until they break something. They have to see how badly do things break.
Dude, there is no sign of moderating inflation in the labor market. So the shelter thing is nice, but like the thing that's tangible in everyone's face outside of the shelter cost is just like the people in their lives. I understand that like shelter's a big component of it. The bond market's saying, kiss my ass with that shelter thing. The bond market is saying this is not over yet.